and the full year GDP number has come in at 8.2% versus the CNBC TV18 poll of 7.8 and versus the National Statistical Organization's advanced estimate of 7.6%. So any which way you look at it, it's a very good number. But I must come to the GVA number because GVA plus subsidies minus indirect taxes is GDP. And because subsidies have been very low and very high in the previous comparable year, that's FY23, there has been a huge impact on GDP, but GVA has not done so well. So the Jan-March GVA has come in at 6.3%. Now that's important. I just told you the GDP is 7.8, but GVA is only 6.3. So that's a huge 150 basis point difference. Normally the difference is 20 basis, 30 basis points. But this big difference clearly indicates that subsidies are still very low and indirect taxes slightly higher. So the net taxes impact tends to be very high on the GDP. I'm still waiting for the GVA number for the full year to check whether there is a similar divergence. Okay, the GVA growth for FY24 is 7.2%. So once again, there is a 1 percentage point, 100 basis point difference. The GDP for FY24 is 8.2, but the GVA is 7.2 if you take out the impact of subsidies. I can give you some more numbers. The FY24 farm growth is 1.4%. The mining sector growth is 7.1%. The earlier NSO estimate was 8.1. Manufacturing sector growth is very good actually. It's 9.9%. The Reserve Bank had indicated that it was a bit worried about value addition in the fourth quarter, going by the quarterly numbers of corporates because commodity prices had gone up, metal prices had gone up, and therefore the EBITDA was not as strong as sales, but it's at least not showing in the manufacturing sector for FY24. It is at 9.9%. I'm giving you full year numbers. Okay, so that's the gist. Manufacturing, 9.9%. Mining, 7.1%. Again, full year. And agricultural sector, 1.4%. Overall, GVA is 7.2%, but GDP for the full year is 8.2%. When was the last time we had 8%? I mean, it's a long time. Of course, we did have a strong number post-COVID because of the very low base. So FY22 was a good number, but 8.2 is as good as it gets. Okay, I'll keep reading out the other numbers to you, but let me get preliminary comments from our panel of experts. Joining me now is former Chief Statistician of India and former Chairman of the Statistics Commission, Dr. Pranab Sen. Also with us, Kaushik Das, the Chief Economist with Deutsche Bank, and Madhavi Arora, the lead economist at Emkay Global Financial Services. Gentlemen and Madhavi, thank you very much for your time. Dr. Sen, so good to have you back, sir, on the show. Your thoughts, 8.2 is a solid number, GDP number, but GVA 7.2.
It's quite a surprise, Latha.
Okay.
I expected, I was completely in sync with RBI. I expected the fourth quarter to be relatively weak, and manufacturing seems to have belied us. One doesn't quite know what's going on there.
Okay. To be fair, if they are deflating with the WPI has still been negative or next to, 1% or so.
It's not negative.
Yeah, so perhaps the deflator has also helped the manufacturing sector. Sir, but I wanted to ask you, we've been saying that the GDP is damn good, but GVA is only, a good 1 percentage point less. A GVA of 7.2% is no laughing matter. It's still a very strong economy, would you say?
Yes, it is. I mean, there's no question about it. 7.2% GVA growth is extremely strong.
Okay.
But again, if the main causal feature is the very low inflation, then of course the GVA gets impacted in exactly the same way that GDP does.
Okay. Yeah. Let me come to your FY25 forecast in just a minute. Given this huge base, whether you will start revising lower your FY25 forecast. But before that, preliminary comments from Kaushik and Madhavi as well. Kaushik, your thoughts? I think I've read out most of the numbers to you, full year. I can read out the Jan-March numbers as well. Farm sector growth is 0.6%, mining is 4.3%, manufacturing is 8.9%. So again, fourth quarter manufacturing, despite RBI's misgivings, very good number, 8.9%. And of course, the full year is 9.9%. Construction sector, 8.7%. That's about the numbers I have at this point in time. I'll come to public administration in just a bit. But your thoughts?
Latha, nice to have you back as well. And, obviously the GDP number is, refreshingly high. And I had tried to be as bold as possible and put a 7.3% forecast for January, March. But it has still come higher at 7.8. The real GVA, I had somewhere around 6.5. So I'm not surprised with this 6.3. And this difference was expected again because of net indirect taxes, difference. Now, the thing is, you got close to 8.2% in FY24. What is important to understand, not just the difference between GDP and GVA, which is happening because of the net indirect tax. The other part is the deflator. So if you remember last year when we started projecting for FY24, we were giving a forecast close to 6.5%. In that, we expected the nominal GDP growth to be 9.5%. And we were thinking the deflator will be 3.5%. So what has happened is the GDP deflator, because of WPI being very low, has fallen to 1.5%. So we are not very wrong with our nominal GDP forecast. So nominal GDP should be somewhere around 9.5%.
Yes, it is 9.6%.
So you've got 9.6 and you've got 8.2. So the GDP deflator has become 1.4 instead of the 3% or 3.5% that we initially thought at the beginning of the year. And that 9.6 comes down from 14.5 and somewhere 18% before that. So it's WPI inflation, which is, kind of causing a problem with the GDP deflator and artificially boosting up, the real GDP growth. And on top of that, you have the divergence between real GDP and real GVA. So I would, place more faith in real GVA number. And if it is 7.2, after taking care of the GDP deflator and all these issues, I think India is growing at 6.5%, 7%, which is still a good number compared to what we thought earlier after the pandemic. But I think growth is still below the inflation and others, have kind of come off. So that will be my initial reaction. Good numbers, but you have to take this, statistical issues into mind while you're analyzing the data in details.
Okay, I just have a number to give all of you. The private final consumption expenditure has risen by only 4%. So there is still a struggle over there. Well, some might say that in this stage, we should be investing more and consuming less, which we are. The gross fixed capital formation has risen by 8.9, almost 9%. If I'm not mistaken, these are quick math that I'm doing. But I think that is a very good number, rising by almost 9%. But let me just check it once again before I give that number. Yes, it is 9%. Gross fixed capital formation is up 9%, but private final consumption expenditure is up only 4%. That's the additional info for you, Madhavi. What have you made of the number? Sorry, go ahead, Kaushik.
If you remember, private consumption, unless they've revised the numbers, October, December was 3.5% and July, September was 2.8%. So it's a slight improvement to 4% in January, March, which is along the expected lines. But private consumption within the GDP number remains weak, and that is close to 57% of GDP. So if you have to find some fault with the GDP, it's just that the private consumption part is weak and the GDP deflator, which is artificially boosting the real GDP. But if you take all that out, still, I think India growing at close to 7% or slightly below that, I think that would be a very, very good number compared to what we thought earlier about the growth projections.
Okay, Madhavi, your thoughts first on the GDP and the GVA number 8.2 and 7.2, both of them far ahead of the CNBC estimates, as well the demand side.
So, when we, the first half numbers were out around 8.1%, the expectation was that, we'd probably see a slower growth in second half to the tune of around, less than 7%. Clearly, second half also seen a healthy average of above 7.5 to 7.8%. And I think both the third and fourth quarter have been an upside surprise. So overall, I think a very good number. If I look at the internal, pretty much similar to what we were expecting on the fourth quarter. We were expecting the West to be massively high because the net indirect taxes were tracking somewhere close to 30% as against what CSO has given us, which was close to 8 to 10% growth. So this was a expectation from our end as well, that you're going to be seeing I think close as you get into the next year. Now, when I look at the fourth quarter numbers, especially on the expenditure side, you mentioned that the private consumption has actually grown close to around 3.5%, if I'm not mistaken.
4%.
Which is again actually much higher than what they had estimated for the fourth quarter as per the implied numbers of CSO. So they were expecting close to 1% for fourth quarter. We were expecting a tad higher number of private consumption and a tad lower number on capital formation for the fourth quarter, which is what it has turned out to be. So I think, but overall for the whole year, I think the internals are pretty healthy. Of course, as Kaushik also mentioned, that the mix that you are seeing as far as the consumption and investment story needs to be watched out for, because you are looking at consumption which is growing at less than 3% and investment which is growing at above 7 to 8%. So you'll have to find some kind of a balance with regard to demand supply of these these components as well. Otherwise, there's going to be a major imbalance unless, of course, the export component sort of takes care of the difference between consumption and investment.
Fair point. Dr. Sen, the other number I wanted to share with you all, tertiary sector has grown by 6.7% in the fourth quarter. Now, I'm giving you fourth quarter numbers, but trade, hotels, transport and communication, which is arguably, I think, one of the employment-heavy sectors, especially informal employment, has grown by only 5.1%. Should we worry about that? Does this mean that this is the proverbial K-shaped recovery, that the growth is not coming to the employment-heavy sectors?
Well, we certainly should worry, but Latha, we should also worry about the fact that the non-corporate sector has still not been factored into these estimates. Remember that. The data we are getting is still primarily from the organized sector. So I think that there is a question mark there. And the consumption numbers are something that we need to think about. But just to complete the story, do you have the discrepancy? What's happened to the discrepancy term?
I'll just get it to you in a minute. For the full year, 1 minute. This is still giving me agriculture. Okay. The output side, I'm not able to get to the discrepancy in the final quarter is minus 0.8%. But that's, of course, the follow from the previous quarter, for a year ago quarter. I'm not able to get for the full year. Give me a minute, sir. I should be able to get it. Oh, sorry, it's taking time. Okay, I'll give you the discrepancy number in just a minute. I just wanted to ask you, Dr. Sen. Okay, I can give you the whole number, but this won't be of much value.
No, it is.
It is 129,000 crore. 1,29,000 crore, but I still have to calculate the difference. Whereas previous years, the discrepancy is a minus, this time it is a plus. So I don't know if that is impacting. Last year, the discrepancy is minus 5.5 lakh crore. This time it is plus 1.29 lakh crore. Does that help?
Well, it does. Basically, the issue is that when you have a problem in the deflators, because you use different deflators for different items in the national accounts, if there's a problem in deflators, it usually shows up in the discrepancy term.
Okay.
That's why I needed to know that. So but the big story, Latha, out here is that these numbers are great. But the numbers of private final consumption are deeply worrying. Even though there is a little bit of a recovery, when you're looking at the totals, a 4 percentage point gap between, more than 4 percentage point gap,
5
between the GDP growth and the private final consumption expenditure is deeply, deeply worrying. This should not exceed more than 1.5%. It's usually around 1%.
Okay. Oh, so would you worry that if consumption is low, then the ability of growth to sustain itself could be impacted? What would be the big worry?
I
Or
think
is
this
it only an
the point that
inequality
Madhavi was
worry?
making.
Sorry, sir.
This is the point that Madhavi was making, right? Which is that unless consumption grows strongly, the incentive to invest will weaken.
Okay. Okay.
So its dynamic implications, I think, are pretty serious.
Okay. Yeah, and of course, the inequality impact also that it seems to wreak. Kaushik, I wanted to ask you, with such a strong GDP and GVA number, 7.2, does that make does that make you to revise the FY25 numbers? The Reserve Bank is standing at 7. Can it continue to maintain 7 with a base of 8.2?
Yeah, Latha, ideally everything remaining unchanged. If your last year has gone up quite a bit compared to your projections, then this year would be more challenging to meet because the base is high. But the thing is, RBI last April only they could have changed the forecast from 7 to higher if they wanted, but they did not do it. Probably because they thought anyway the January-March number will come much stronger than what the implied rate was being calculated out of the CSO projections. So if you remember, in order to get 7.6, you needed a 5.8% real GDP growth for January-March. So instead of 5.8, you got 7.8. So I think RBI had already taken that in their calculations for last year, and therefore they did not change the growth forecast anymore from 7% that they had. So I have a similar 6.9 for FY25. But as we all know that these data are subject to huge revisions, and the previous year's number can change. And if it is revised downward later, like the FY23 number was revised down, that could give some support to FY25 number. So all these things at this point, depending on how badly you miss this GDP forecast of January-March, you will determine. Now, we were at 7.3 and it came at 7.8. So I don't need to change any forecast at this stage. I'm okay with 6.9, what has come out, what is there for FY25. But just one point on the private consumption part. Part of the reason why it is so weak or it is looking weak is because of the agricultural sector, which had a bad year, previous year because of the patchy monsoon. And private consumption is reflecting part of the weakness. Now, this year, probably the rural sector will do better if the monsoon, is better than last year. But what we need to worry then is whether urban consumption will keep pace after doing the heavy lifting in the last 2 years. So overall, private consumption being such a big share of GDP, close to 60%, would remain, item which would be under focus. So I would think after a few quarters, RBI should think about easing policy rates with a forward-looking bias, thinking about FY26. The question that you asked, whether the momentum can be sustained or not. On one hand, you are doing fiscal consolidation, which will gather more traction once the elections are out of the way. So you need some support from monetary policy to support growth. Close to 7% is what I would think. And because monetary policy is forward-looking, probably after a few quarters, RBI should start thinking about easing rates. Is what we think for the economy as a whole.
Okay. Well, it's a little difficult to argue that growth is being held back by interest rates. I mean, growth is charging ahead. It will require the Reserve Bank a lot of comfort to be able to, cut rates when growth is just steaming ahead. I mean, this is by far one of the best record-shattering numbers that we have got in terms of GDP. The GDP at 8.2 is way above the CNBC TV18 poll of 7.8, which already is a revised number. Okay, Madhavi, to you. Do you think that you yourself will tweak the FY25 number, or RBI has to because of the base?
So clearly, as Kaushik also mentioned, higher FY24 growth also means that the base for FY25 to start from will also be much higher. So at this point, we're still looking at FY25 GDP moderating to 6.5, 6.6% from 8.2, while the production side GVA may only be tad lower next year to the tune of around 6.3, 6.4%. So the massive wedge that you've seen in FY24 will likely normalize as you get into the next year. And of course, I think the slower growth outcome will also be, I think, probably see some cyclical headwinds in the form of lower government net spending growth, and of course, feeding terms of trade benefits that you enjoyed because of lower commodities on year-on-year basis. Also, probably, the continuation of relatively tight banking lending standards, as well as weaker exports as well. Besides, in FY24, you also saw a deflator-related growth boost, which will obviously unwind as you enter in FY25, as WPI would probably retrace close to 4% plus level. So we'll have to see other thing, but I also agree with Kaushik that you may see the urban-rural divide narrow a tad as rural side probably will cyclically pick up in early part of this year. And also, to some extent, you will see services sectors continuing to stay resilient, and probably the wedge between services and growth to also sort of normalize. But both of them, I think, should moderate in FY25 versus 24.
Okay. Well, I have to give you another excellent piece of news, which is, again, lagged, but still very good. The government's fiscal deficit for FY24 is 5.6%, not 5.8, as the revised budget indicated. So that's yet another feather in the cap. In spite of the fiscal deficit being lower, even actually in terms of aggregate numbers, it's lower. It is coming at 16.5 lakh crore. If I remember right, the revised estimate put it a little north of 17 lakh crore. So the fiscal deficit is actually 95% of the revised estimate. It's lower than what the revised estimate put it. So that's yet another very important factor that, that will be a plus point for the country's macros. Dr. Sen, your comment on that, plus this one point that you were asking, discrepancies, from minus 5.5 lakh crore, it's now plus 1.29 lakh crore. That's a 6 lakh crore swing, perhaps a little more than 6 lakh crore. It's about 2% of the GDP. So your thoughts on both? Does that make things look a little better than it actually is?
Fiscal deficit news is certainly good news. It's great news, in fact. Okay. I wish that we can now just continue and get back to 4.5 as soon as possible, without actually disturbing the growth story. Okay. As far as discrepancy is concerned, so you're saying it's now a positive...
Yes, positive 1.29 lakh crore.
Yeah, which means that the expenditure side of the accounts is understating growth. Oh. Okay. And so what it means in effect is that the discrepancy between the CPI and the WPI is playing a very large role. Mm-hmm. And we all know that. I mean, the CPI has been hovering around 5%. Yeah. And the WPI is sub 1%. Yes. And that's what's really causing
a lot of
these kinds of numbers to emerge.
Fair enough.
Yes. So basically, what is saying then the production side.
Okay. God, that's just let me get thoughts from others as well. Kaushik, your thoughts, fiscal deficit lower than expected. Would you therefore reiterate your expectation of a rate cut from Reserve Bank sometime in 24?
So, Latha, it's a very, very good development. 5.6 means that you could probably go below 5% in FY25 itself, because RBI has given a big dividend to the government of India. Even with 5.8, we were thinking that the fiscal deficit could come down to 4.9 if the government were to choose to reduce deficit and not spend it completely. Now with 5.6, it will be even easier to go down below 5%. And, the 4.5% target that has been set for next year, you can actually better it. And if you've seen today, Standard & Poor's have said that, in 2 years' time, India is looking for a ratings upgrade. I think India is looking at a ratings upgrade much sooner. And, the faster you do fiscal consolidation, and this gives room to the government to do fiscal consolidation at a faster pace, because the numbers of the previous year are already much better. The GST, collection is holding up pretty well. This year also, nominal GDP growth would be close to 11%. So I think, you could get down below 5% this year itself in FY25 when the budget is presented. And, then next year you could be better than 4.5. You could look for a ratings upgrade pretty soon for India, given the macro story. Okay. So that is very good. On the deflator bit, the problem that we have is that we don't have a services CPI deflator. So, and services sector is close to, 65% of GDP. So today, if your deflator was, say, around 3%, if you take WPI at -1 last year and CPI at 5.4, and we know that WPI is given a bigger weight. If it was at 3%, so 8.2 minus 3, you could have been at 5. So I don't think India is either growing at 5 or India is growing at 8.5. We are somewhere at close to 6.5, 7% if you adjust for the deflator issue, which is still a much better scenario than what all of us thought 2 years back coming out of the pandemic. But I think this growth momentum at 6.5% at least will continue from the real side for the foreseeable future. And for nominal GDP, you'd be at 10.5, 11% on an average. That itself will help fiscal deficit ratio to come down, tax collection to be buoyant. And very soon we should be looking for a ratings upgrade, in my view, provided we don't get an external shock or anything on the fiscal side.
Okay. Well, it does look like we have enough tools to, thwart any external shock. I just wanted to check out whether the lower fiscal deficit is because of lower spending or because of higher tax collection. Actually, it's both. So very good. Spending is slightly lower. One can understand that in an election quarter. The government spending FY24 is 44.4 lakh crore compared to 44.9 lakh crore, which was the revised budget estimate. But receipts are also higher at 27.9 lakh crore compared to revised estimates of 27.55 lakh crore. So, done well on both. Therefore, this is a very good fiscal deficit achievement. Okay, Kaushik, if you very briefly could say what were you saying about the deflator? The GVA at 7.2 indicates that, even if you take away this subsidy mesmerism, it still is a very good number. But what were you saying about deflator? Is that...
I'm saying it depends. See, this is a legacy issue that the way the GDP deflator is calculated, and Dr. Sen will know much better than me on this, is that WPI is given a much bigger weight, close to 70% or 65%. And on CPI, we don't have a services deflator, which we should use to kind of deflate the, different items. And services sector is a big item, big, contributor to GDP. So what is happening is the GDP deflator is getting reflected based on WPI inflation more, whether it is on the upside or downside. And that is, kind of making the real GDP a little volatile. So question is whether you should look at the nominal GDP, which has come down to 9.6 from 14.5, or should you look at the real GDP, which is at 8.2%, coming up from 7% of the previous year. So I think the story is somewhere in between, and India going close to 7% if you adjust for all this, which is still better than what you would have expected, 12 to 18 months back. But you have to take the GDP deflator issue. I'm sure like CSO will look into all this, and in future we'll have a better deflator to calculate the real GDP out of the nominal GDP.
Yeah, fair enough. I think I just want winding up comments from all of you. Madhavi, what's your current FY25 number? And is it likely to be revised higher after looking at the strong quarterly and full year performance?
So for next year, we are at this point in time still sticking at 6.6% on real GDP. I'll have to look in the details to see whether we are revising it, upward or downwards. But I think the composition, as I mentioned, should sort of see moderation both in manufacturing as well as in services in FY25. Overall, I think, except for agriculture, I think both these big components should ideally see moderation owing to various factors that are discussed earlier. Okay. So as of now, sticking to that number.
6.6. Kaushik, your number is?
So we have 6.9% for real GDP FY25, and then going down to 6.5 in FY26.
Okay. Well, I would defer to RBI because for I think 2 years in a row, their estimates from April have been higher than the street estimates. And actually, everybody has revised higher to their level, and RBI itself has revised its number higher. Remember, we began FY24 with an expectation of 6.5 from RBI. And where are we now? 8.2. I mean, this is so good. A 9.7% growth in FY22-23, FY22 that is. FY23, we go to 7% and now 8.2. So 3 years in a row, the average works out to well over 8%. Really a jolly good number. Dr. Sen, final comments. Do you think we are in for a great current year as well, FY25?
Well, there are so many surprises, Latha. First of all, we keep forgetting that, we are in the lead up to the elections, or the elections
Yes.
are on. And one normally expects a huge boost during the election year with a bit of sort of slowing down in the year following the elections. And so we've got a GDP boost certainly in this year, but there's nothing in government finances and expenditures which suggests an election year behavior.
Okay.
Which is a very good thing.
Yes.
So next year, I think we are going to be in a situation as the government takes over and starts looking at the numbers again, whichever government comes. But I think we should see some moderation. And I would probably say that we will be in the 6.5 to 6.7% range.
Okay. That's still a damn good number on a base of
It's still a good number, yeah.
Absolutely. Okay, thank you, Dr. Sen, Madhavi, and Kaushik Das for parsing the all-important GDP numbers for us. It's a earth-shattering, record-shattering set of numbers that we have today from the NSO. The Q4 GDP growth has come in at 7.8% against market estimates of 6.7%. That was our poll. That's the Informist poll that was